Real estate investment practice problem using OneNote. Amortization schedule with early payments. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, Practice Problems tab, down in the 4230 Amortization Schedule Early Payments tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below, our scenario being that we're thinking about setting up our loan structure and then planning to pay early throughout the loan structure. So you want to make sure that you have the capability of doing this in the particular loan that you are in, meaning could we set up our loan in such a way that we can have our payments being sufficient that we think that we could cover them in the event that there are problems in the future, while still planning and hoping that we will be able to pay off a larger amount and thereby pay off the loan earlier than it otherwise would be paid off. So when we look at the loan itself, we're talking about a $300,000 loan. Just for an example, this could be a scenario where you could be picking any kind of loan that you're thinking about and saying, okay, I want to set up the loan to have the payments structured, have the lowest interest rate, and so on and so forth. But then I'm really planning on paying it off early by increasing my payments. This is something that's a little bit difficult to plan for or think about when you're using, say, online calculators, because it can be difficult to adjust the amortization schedule for payments that are going to be made early. Also, if you make payments early and you want to just adjust what the amortization schedule will be at that point in time, it can be useful to do that, and it's easier to do that if you have the amortization table in Excel. We do this practice problem in Excel if you would like to look at it there, and we have the Excel worksheets that if you would like to use the Excel worksheets to help you with whatever planning that you are doing, you could do that as well. So we have the home of $300,000. We're not putting anything down because we just want to concentrate on the loan at this point. So we just have a loan in essence of the $300,000. We're going to say it's a 30-year time, so 30 times 12 would be payments of $360. We're going to say the rate is going to be 4% and just keep it at that. Nothing else confusing going on at this point. That would mean the calculation for the payment using the payment calculation would be the $1,432, and then we could think about what the total payments would be on the life of the loan. And if we have these nice even payments throughout the life of the loan, we can simply take those number of payments, the 1432.25 times 360 periods. That would mean we'd be paying $515,610 over the 360 periods, or 30 years. If we subtract out that minus the loan amount, $300,000, we get then the interest of the $215,609 that we would pay. Now, if we pay this thing off early, then we could still be paying the 4%, but if we have payments that are higher than the $1,432 over the life of the loan, we're going to be paying it off at an earlier point, thereby reducing the total interest and payments that we will be making, remembering that interest is basically kind of like rent on the purchasing power of the money. So we got the $300,000 in order to purchase the home, and we're paying rent on it, in essence, basically interest for the purchasing power. If we pay it off earlier, then of course we'll pay less in terms of interest, and we'll have less in terms of the total payments. The comparison then is just the same. We're going to have the same information, but we're just imagining that we pay it off earlier and adjusting the tables. Now, obviously, once you start thinking about these kind of comparisons, you could then think about, well, what would happen if I add the points here and I pay points and then I still plan on paying it off early? Would it still be worthwhile to pay the points versus not paying the points, and so on? You could do the same with a lender credit and start looking at different scenarios where you expect to pay off the loan earlier, even though you're pulling in or taking out a 30-year loan. So in the second scenario, we're going to be saying that we're going to increase the payments by 10% on each of the years after year one. So we're going to assume on the second scenario, in year one, we pay the 1432 about, and then we're going to increase by 10%, or 1432.25 times 0.1 or 10%. So we would increase it by the 143, adding that to the 1432.25 would give us about the 1575. And we can also calculate that by simply taking 1 or 100% plus 0.1 or 10%, 1.1 times the 1432.25, which would give us the 1575. If we take that and in year 3, we're going to assume we increase it by 110% or increase it by 10% again. So times 1.1, 110% would give us the 1733 times 1.11906 times 1.1 is going to give us the 2097. So this is going to be the increases that we're going to have for the 5 years following the start of the loan, and then we're just going to assume that 2097 is going to be what we'll pay throughout the rest of the loan term. So then the question is, well, where will we stand in this type of scenario? Obviously, this is not something that we're required to do in the loan because we're only required to pay the $1,432.25. We're choosing in this scenario to pay more and planning for us to do that and try to pay the thing off earlier, and that's going to be our side-by-side comparison. So obviously the first one then, we're just taking the $300,000 loan. We calculated the payment amount at the $1,432, which is the same in both scenarios. The first scenario, however, then we'll keep that same amortization table all the way down, and we'll see that, of course, at the end of it, will be at 0 at the end of it. On the second scenario, we're going to try to say, okay, let's make the adjustments that we hope to be happening on a year-by-year basis. We're going to start in year 1 and just pay off that $1,432, but in year 2, we're thinking that we're going to be able to pay off more at that point in time, increasing it to $1,575. So in the amortization table, we can simply adjust this payment to $1,575. Notice I'm also going to adjust the green amount here so we could see year 2 in this kind of banded scenario. That allows us to see it a little bit more clearly, I believe. So we're going to have the $1,575 for all of year 2, the 12-month time period. That then is going to, the interest is still calculated the same. It's calculated on the prior balance times the interest rate. So it's still the same calculation of the interest. We haven't changed the rate or anything like that. But having increased the payment means that the payment minus the interest will go up, or in other words, the reduction in the principal has gone up. That means that the loan balance, which is the prior loan balance minus this number, the reduction in the principal or loan balance, the loan balance will go down at a higher rate. And when it goes down at a higher rate, then of course you'll also be paying more interest because the next interest calculation will be the new loan balance, which is now lower than it otherwise would have been, times the same interest rate. And so if we do the same thing again, the payment is higher, and now we have the interest rate is going to be lower than it otherwise would have been because the interest rate is the same, but the loan balance is lower than it otherwise would have been. That means that we're going to be paying off more of the balance than we otherwise would have, and that's going to lower the loan balance. So changing this one cell and then simply copying it down should, in essence, kind of rework your amortization table. Although, of course, now it's not a nice even table. It's not going to work out after 30 years. It's going to result in paying it off at an earlier time. And then in year 3, we said we increased it to $1,733. So we're going to assume 3 years out that we're going to make more money. We're going to be in a position to pay it off sooner. Not that we're required to, but we're trying to set up our loan in such a way that we have the ability to, and we're planning to be able to do that. So then we're going to say $1,733, once again, increasing this amount. The interest rate is still being calculated on the prior loan balance. That then is going to result in a higher amount of the principal reducing, making the loan balance go down more rapidly. As the loan balance goes down more rapidly, multiplying that amount times the same percent will result in less interest. So interest is going down faster. The loan balance is then going down. The reduction is going down faster, making the loan balance go down faster. In year 4, we increased it to $1,906 for this full year. And that means the same kind of scenario is happening. We're accelerating the decrease in the loan balance. And then in year 5, all the way down to however long the loan goes, we're going to assume we can pay off 2097. So then what we would do then is we could scroll on down and say, okay, well, when does this thing end? It's going to be paid off earlier than the 30 years. So I can go down here and say, okay, sometime in year 18, 17, something, it's going to be paid off right there. And that last payment is going to be a little bit different because obviously the last payment you'd be owing the $384 plus the interest, which is $385. So that last payment will kind of throw it off a little bit. But your amortizations table will then look funny because obviously you paid it off sooner. If you use the same amortization table in Excel, you'll end up with these negative numbers after the point in time that it has been paid off. That's not really a problem because obviously you're just looking at the point in time when the loan balance goes to 0. Once it goes past 0, then the loan has been paid off. So it'll look kind of funny, but you'll be able to calculate it fairly easily in Excel. If you set it up in Excel much more easily than you would be able to do if you put it into most loan calculators, because they might not have the capacity. Many of them don't, or even if they do, it's not quite as flexible possibly to just adjust the payments and increase the payment level and then do your comparisons based on that analysis. Once you have this information set up, then you can do the same kind of thing. You can kind of compare and contrast, do your internal rate of return with different types of scenarios, possibly comparing and contrasting, of course, this scenario versus just paying the normal balance all the way through, which means you're going to have a difference in the interest level and payments that you'll have, and or different scenarios with points and so on. We'll also look at a future presentation which will help us to format this worksheet. So if you wanted to set up your worksheets in such a way that if it goes past 0, it no longer has these negative numbers, and that way you can basically format your amortization tables and make them look a little bit more professional that way. We'll look through some formatting tools to do that in future presentations, which we'll just do in Excel. We won't do them here in OneNote, so you can look at that formatting issue. I don't really mind the negative numbers myself because, again, as long as I can see when the loan balance is going to terminate, that's useful for me. But the negative numbers can look kind of unprofessional, and they can basically make it look kind of messy and harder to see. And if you're doing this for somebody else, then you might want to clean that up a bit. There's kind of a trade-off between cleaning up these negative balances with a formula, which would be a logic formula, like an if formula, if-then formula, and not doing that, because not doing that means the cell references in these amortization schedules will be as simple as they can be, fairly simple. You can look at the Excel and see what's happening by just looking at the cell references. When you add if formulas to compensate for things like negative balances and then apply them to every cell in the table, you'll convert a very simple formula to one that's much more complex. For example, this cell over here is just referencing the payment amount. If I was to change it to not have any payment amounts down here once it turns 0, I'm going to have a much more complex logic formula with if in it. But again, we'll talk about that if you're interested in that in future presentations. You can then use this, you can calculate this into a pivot table if you so choose, and then you could see this information in terms of a pivot table, which could help you to do analysis. We won't go over adding the pivot table because we've seen it in the past, but that can break out your yearly numbers, consolidating everything down into 30 years, and then you can see very quickly, which year you're going to be paying this thing off in. Might be easier to do analysis such as that with a pivot table to get a nice quick glance of what could happen if you were to pay off the balances earlier or have some lump sum payment, or if you expect to have some large dollar amount coming in at some point later that you can use to pay off the balance. What might that look like if you were to pay that? Those types of scenarios might be easier to do if you then glance at them with a pivot table, so you could see it on a year-by-year basis. Also note, if I look at the IRR, basically the internal rate of return calculation for the scenario where we paid it off early, so we have the cash inflow of the $300,000, then we paid $1,400, increased it to $1,575, and so on with the payments. and we calculate the IRR, we still get to an IRR of 4%. In other words, even though we paid it off early, we're still going to get to an internal rate of return of the 4% because we're still, paying 4% throughout the entire thing, even though we're basically paying it off earlier. However, it will be beneficial because your interest payments will be less. So when you do your comparison, one kind of problem with these negative numbers is the bottom line number down here can be a little bit more difficult. You can't just sum up the total payments. You have to stop the payments happening at this point. So that's another reason it might be a little bit easier to see the format in a 30-year period, because then in Excel you could just highlight the payments down to the last payment and then just calculate whatever that last payment is going to be, and then you can determine how much you would be paying instead of having to go to the bottom. You can't really go to the bottom because, again, it's going to be terminated more than 30 years. So this is one instance where if we use those logic functions, which we'll talk in the future, you'll still get these totals down here and they'll be correct. So it can be useful in that scenario, but it's not too difficult to basically sum these up in Excel and figure them out as well. And then you could sum up the interest, just highlight the cells and figure what the interest will be in those calculations. So the benefit here would be that the interest is going to be lower and the total payments would be lower as you pay off the loan earlier, and you'd have the loan balance paid off earlier in that scenario. So we'll do some more comparisons. Like I said, it could be useful if you're doing scenarios like this. It might be useful. There's a trade-off in whether it be useful to have the formats, the if functions, the logic functions. If you want to look at those, we'll take a look at those in the future. We will also provide a worksheet that actually has the logic functions in place and one that doesn't, so that you can use either one that makes sense to you. The logic functions mean that when you adjust the payments, you got to be a little bit more careful because you're going to have a complex formula when you adjust, say, the payments, like these payment cells. However, then it'll remove the negatives and you can get a total number on down below, which will be easier to see versus, again, if the other non-formatting with the less fancy formatting, where you can have an easier see of what's going on in the amortization table and make the changes easier, but then you got this messy situation at the bottom, and you can compensate for that by basically just highlighting the cells in Excel and summing them up that way instead of being able to rely on the totals down below. Notice that these negative numbers aren't a big problem when you're looking at a situation where, say, you're changing the term from 30-year to 40-year to 15-year. That's the other scenario where you'll come up with negative numbers in the bottom of the Excel worksheet. That one's not as big of a problem because you can still kind of figure out the total payments and the interest here because they'll just be even payments. But when you're paying it off early, and this way you can't really calculate the total payments that easily, and that's when you still need those total numbers in order to see the total interest and the total payments and so on.